Inflation. We've been told that it's the biggest threat to REITs. Rising inflation may lead to rising interest rates, which is bad for REITs. But what happens to REITs in a deflationary environment? Let's discuss that briefly in this video. Do hit the subscribe button now if you would like to stay in touch with topics like these. As we know, REITs are extremely sensitive to rising interest rates. This is because REITs often rely on borrowed capital to fund their growth, as most of their income will go to unit holders in the form of distributions. As such, inflationary environments are often anathema to REITs. But on the flip side, deflationary environments will affect REITs negatively too. A deflationary environment is characterized by a general decline in prices across various goods and services in an economy. This can have several negative implications for REITs. The first is falling property values. Real estate prices typically follow the broader economic trends. And in a deflationary environment, properties can lose value. This means that the underlying assets of REITs will depreciate in value. As a result, the net asset value of REITs will decline, impacting their overall performance. Secondly, is reduction in rents. In a deflationary environment, tenants will have reduced pricing power and may struggle to meet their rental escalation obligations. With this, tenants may demand rent reductions or seek lease renegotiations to adapt to the economic downturn. And thirdly, there will be reduced demand for investments. Deflation can dampen investor sentiment and confidence. As such, more investors will generally shy away from investing in shares and REITs. Instead, in deflationary environments, more investors tend to seek shelter in instruments such as bonds and gold as a hedge against paper currency debasements. This would lead to less demand for stocks and REITs, putting downward pressure on prices. What should REITs investors do in deflationary environments? Firstly, stick with REITs that are well diversified across different property types and geographic regions. Some property sectors like healthcare may be more resilient in a deflationary environment, while others, such as retail and office spaces, may be more vulnerable. Secondly, stick to REITs with strong and conservative balance sheets. These include REITs with access to sufficient liquidity to cover operating expenses and debt servicing obligations. A robust financial position can help REITs weather deflationary environments more effectively. Thirdly, stick to REITs that offer flexible lease structures to their tenants. This may include shorter lease terms or rent concessions. The existence of these terms can protect rental income against the erosion of purchasing power. Fourthly, stick with REITs that own quality properties in desirable locations. These REITs are more likely to retain their value and generate steadier income, even in a deflationary environment. And lastly, do look out for REITs that have portfolio enhancement strategies for such climates. Deflationary environments provide opportunities to prune non-core assets and upgrade existing ones so that the assets are better positioned to benefit when deflation eases. In conclusion, REITs face challenges related to falling property values, reduced rents, and reduced demand in times of deflationary environments. But deflation can also provide portfolio enhancement opportunities for REITs. And these REITs will emerge stronger when the situation eases. Do you have any other thoughts with regards to how deflation affects REITs? Do leave us a comment below. And drop us a like and hit the subscribe button if you found this video useful.